Welcome back to CPA Mastery. In this lesson, we are focusing only on dividend income, which is another major category of investment income tested on the regulation section of the CPA exam. Dividends occur when corporations distribute profits to shareholders. Because shareholders receive an economic benefit, dividends are generally included in gross income. The most important concept in this lesson is the difference between ordinary dividends and qualified dividends. Both are included in gross income, but qualified dividends may receive lower tax rates. By the end of this lesson, you should understand what dividend income is, how it is taxed, and how the CPA exam typically tests dividend questions. In this lesson we have three main goals. First, we want to define dividend income and understand why it is generally taxable. Second, we want to identify the most common sources of dividends, which usually involve stock investments and mutual fund distributions. Third, we want to distinguish between ordinary dividends and qualified dividends, because that distinction affects the tax rate applied to the income. For the CPA exam, the biggest mistake students make is confusing tax rate treatment with inclusion in income. This lesson will help you separate those two ideas clearly. Dividend income represents payments made by corporations to shareholders out of corporate profits. When an investor purchases stock, that investor becomes a partial owner of the corporation. If the corporation earns profits, management may decide to distribute a portion of those earnings to shareholders. Those payments are dividends. Because the shareholder receives money or property, dividend income generally represents an economic benefit. For that reason, the IRS usually treats dividends as taxable income and includes them in gross income unless a specific rule changes the treatment. Most dividend income comes from owning corporate stock. Public corporations often distribute part of their earnings to shareholders as dividends. Taxpayers may also receive dividend income through mutual funds or brokerage accounts that hold dividend-paying investments. Even though the money may arrive through a fund or investment account, the underlying concept is still the same. The taxpayer is receiving distributions connected to corporate earnings. On the CPA exam, when you see income generated by stock ownership rather than lending money, that income is often dividend income rather than interest income. Ordinary dividends are the default category of dividend income. If a dividend does not qualify for special treatment, it is generally taxed at the taxpayer's ordinary income tax rate. In other words, it is taxed like wages, salary, and most other ordinary income items. For CPA exam questions, this gives you a practical rule. If the problem says a taxpayer received dividends but does not tell you they are qualified, the safest assumption is that the dividends are ordinary. That default assumption will help you move through exam questions more efficiently and avoid adding complexity that the problem did not actually give you. Qualified dividends receive preferential tax treatment. Instead of being taxed at ordinary income rates, qualified dividends may be taxed at the lower rates that generally apply to long-term capital gains. However, the key point is that qualified dividends are still included in gross income. The classification changes the tax rate applied to the income, but it does not eliminate the income itself. This is one of the most important concepts for the REG exam. Students often hear qualified and assume that means the income is excluded. That is incorrect. Qualified dividends are taxable income. They just may receive a lower rate. Let's look at a basic example. Suppose a taxpayer receives $900 of dividends from corporate stock and $300 of dividends from a mutual fund. To determine the total dividend income, we simply add the two amounts together. In this case, the taxpayer has $1,200 of dividend income. Unless the problem states that part of the dividend receives special treatment, the exam is usually testing whether you can identify dividend income correctly and include the full amount in gross income. Here is a typical CPA exam example. A taxpayer receives $700 of ordinary dividends and $500 of qualified dividends during the year. If the exam asks for total dividend income included in gross income, the answer is $1,200. Both ordinary dividends and qualified dividends are included in income. The distinction between them matters when determining the tax rate, not when determining whether the amounts belong in gross income. That difference is a favorite exam testing point. A helpful exam tip is to remember this sequence. First, decide whether the item is dividend income, then decide whether it is ordinary or qualified. Do not jump straight to tax rate issues before confirming the type of income. Also remember that qualified dividends are still taxable. Their classification affects the rate applied, but not whether the income exists. If you keep that sequence in mind, most dividend questions become much easier. Identify the dividend, include it in gross income, and then apply the correct classification. Let's wrap up the lesson. Dividends are distributions of corporate profits made to shareholders. Because they provide an economic benefit to the taxpayer, they are generally included in gross income. Most dividends are treated as ordinary dividends and taxed at ordinary income rates. Some dividends qualify for preferential treatment and may be taxed at lower rates. But both ordinary and qualified dividends are still income. For the CPA exam, remember the core rule. The classification changes the tax rate, not whether the dividend is included in gross income.